Okay, so we've gone through our Apple call option and we have qualified it as a derivative. We've gone through our three criterion. We know what the notional was 100 shares in this particular call option. The underlying was the market price of Apple. So as the market price of Apple stock goes up or down, this contract, this call option contract, either goes up or down depending on if it's a call or a put. So we qualified under criteria number one. Criteria number two, if we bought 100 shares of Apple at the price that we showed earlier, it would cost me around $37,500. Buying this option, where we looked at the current price of around $18.44, it would cost me around $1,844. Little investment to get the same kind of action you'd have in buying 100 Apple shares long at $37,500. So we qualified under criterion 2. The last one is we can sell the option prior to exercise, or there may be actually a component in the contract that says, I don't actually have to take possession of the shares, I can just hand you the option and you give me the net cash settlement. So it's either going to be explicit or implicit to the contract that there can be net settlement for cash. So we've qualified this. So now we've qualified as a derivative. What is the accounting under the financial accounting standards as it's articulated in the accounting standards codification? So this is where we left off in the accounting standards codification, the definition of a derivative. So what we want to do is we want to figure out, okay, what do we do as far as initial recognition, subsequent recognition, etc. So let's just scroll up to the top here and get back to where we want to be, which is basically the table of contents for the overall. And let's look at, we can look at recognition, and we can look at the very first thing, right? 25-1. Entity shall recognize all of its derivative instruments in the statement of financial position as either assets or liabilities. Okay, so if I have this and it has a value, then it has basically I'm owed money, that's an asset. If I owe money, it's a liability. And they should recognize all of them in the statement of financial position. Well, what's the other side of that transaction? Well, the other side of that transaction is articulated here in 25.2. While this particular line is saying, even if you bought something that didn't qualify as a derivative initially, but later qualified as a derivative, then you have to recognize it immediately as either an asset or liability with the offsetting entry recorded in earnings. This is the key piece. So if I wanted to put a very simple spin on this, right? Very, very simple spin, simple definition, accounting for derivatives. It is on the balance sheet, so they're recorded at fair value with any changes in the fair value going to the income statement or to earnings. And sometimes you'll hear me refer to it as to the profit and loss statement. This is basic accounting for derivatives. So if I get into this, anytime I have a derivative that qualifies as a derivative, anything, this is the accounting. It's at fair value and everything goes through the income statement. So if we wanted to take a little bit further look, this is just initial recognition. Let's take a look at what is subsequent measurement, right? So the subsequent measurement is I've had it, we have our initial measurement, I want to take a look at my subsequent measurement and see what happens. This is 35-1, says it all right here. All derivative instruments shall be measured subsequently at fair value. Everything is at fair value. And any changes in the fair value will go through the income statement. It's just that simple. So everything is at fair value, and changes in fair value go through the income statement. Through earnings, through the P&L, it's all the same thing.